through periods of history where there has been high inflation or even in fact hyperinflation, it's generally not the wealthy, it's generally not the elites that are most affected. It's generally the middle class and the working class that have their purchasing power destroyed the most. Because if you're wealthy, if you're an elite, you are potentially either going to be financially savvy, or if not, you can employ someone who is financially savvy to protect your interests, to move money out of a country that is suffering from high inflation, or hedge against inflation, or protect the assets in various means. It's the middle class and the working class, the people who don't see the high inflation coming or the hyperinflation coming, that will tend to be the most affected. Now, this isn't investment advice. Investments can go bad, stocks can go up as well as down, as well as other assets. But I just want to give you a broad outline of my thoughts on essentially protecting yourself from high inflation that could be coming in the future. But do your own research, talk to different brokers, look online. This isn't investment advice. It's just a broad outline of things I'm doing. So the first thing people generally say is, investing, it's dangerous. You can lose all of your money, and yes, that's true. If you have a bad portfolio, an overweighted portfolio in one area, and that area goes bad, you could lose all your money. But look at the other angle. When people in the UK, if you have a pool of savings, that's probably invested either in a UK bank, or the majority of people in the UK, if you own a house, your wealth's tied up in that house. You are very, very exposed. If you're watching this from the UK, if you're US or Canada, whatever. Most people have the majority of their assets and the majority of their savings tied up in that one country they live in. So what seems mad to me is the fact that most people in the UK have nearly 100% of their wealth tied up either in UK property or in UK banks. You are heavily exposed to a crisis in the UK. So with some simple planning, you can spread that risk out. You can put it into countries that potentially will do well while the UK is doing badly. So just to have all your savings in a UK bank, that isn't particularly prudent. If you look at a well-balanced portfolio, just having 100% of your risk exposed either in UK banks or in the pound sterling or UK property, you're leaving yourself very exposed. So just an example for my pension, I've got one of these self-invest pensions where it's okay. I mean, I would like a little bit more control over where the money could be invested, but there's essentially something like 20 different funds in this pension where you can invest. I'm looking to try and get, at the moment it's pretty much in cash. I'm still waiting. Hopefully it's a terrible thing to say, but I think, in my opinion, I think the stock market's going to go down more than it has now, especially emerging markets. I want to scale in to that pension, eventually be investing in funds that are in emerging markets. I think bearing in mind, mid-30s now, so I'm looking at another at least 20 years. I think that pension, you can take it early, around 55. So I'm still looking at 20 years, maybe 30 years before drawing back on that pension. So I want to be in assets that long term, in 20 years time, they are going to be maturing and doing well. And I think emerging markets really represent that. I wouldn't really want all my pension assets being tied up in the FTSE or in the S&P or the Dow, developed Western nations, because long term there's probably going to be a big shift from the UK to Asia. So that's my pension fund, looking to scale into emerging markets. As I say, it's quite blunt-ended. There's only about 2 or 3 different emerging market funds they do, but that's the nature of the beast. I'd rather the money be parked there than it is in the UK, just because of the long-term effects that I see of the problems that the West has compared to the opportunities that are in emerging markets. You want to learn how to hedge against inflation and also against currency risk. So like we said before, if all your money's in the pound and the pound collapses, you lose a big percentage of your purchasing power. So, short-term things that could happen, dollar could rally generally in time of crisis as dollar goes up. So you want to learn different methods you can use to get exposure to different assets. Now, there's various ways of doing it. I mean, I think everybody should really have, an investment ISA. An ISA you can invest in, shares, and most of them allow you to invest not just in the UK. You can buy shares from various different countries around the world. When you buy a stock and it's denominated in the currency that stock trades in, you also not only buying the company, you also essentially exposing yourself to the currency. That can be good and bad, because that stock could go up, but then if the pound rises against the currency that the stock you also bought in, you could potentially still lose. So you buy stock X in, say, Australia, you have it a year, but the pound rallies against the Aussie dollar in that same period, you may even just break even or essentially lose money when you convert back to the UK. But it can also be beneficial. These stocks and shares ISAs, if you can invest in countries you think are going to get the currency is going to go up in value, their currency versus the pound, and also the whatever you're investing in, whether it's a fund, whether it's an ETF, whether it's just an individual stock, you can diversify into currencies which, you know, potentially do well. The problem with the pound's got at the moment, no one really has any clear insight what the hell's going on with Brexit at the moment. You know, I think end of this, so what do we? By the end of this month, we should know or not if we're going to get an extension or not. But then we still get to the end of December. It's still going to be murky waters. Not really going to be good for currencies. And I think as the madness of money printing and ultra low interest rates pans out, pound could potentially be going down. I mean, all currencies have that problem. I'd certainly much rather own like an ETF, whether it be the FTSE, whether it be individual shares, as inflation eventually picks up. I mean, we could certainly have a period of deflation before inflation picks up. As I say, I'm not trying to give people any, like, you need to do this. I'm saying there's many different outcomes that could happen. We could have deflation. We could jump straight to inflation. We could have deflation first, then inflation. It's a real minefield out there. You probably want to try and get a macro view from different economists, or not even necessarily economists, like fund managers. There's many of these videos on YouTube, many different good channels that interview quite prominent fund managers. But there's no one set mantra, right? Some people say we're going to get deflation. Some people say no, that's true. We're going to go straight to inflation. But just taking a weighting of what different people are saying, you can say, well, if we start seeing deflation, I want to do this with my money. Or if we start seeing inflation, I want to do that with my money. So I generally have like a little bit of a plan. So at the moment, I'm not really invested that much in the stock markets, just a little bit through my pension and a little bit through an ISA, but mostly waiting just to see what happens. And I have just on notepads, well, if the FTSE falls to this level, in my opinion, that could represent good value. Maybe look to buy here. But I'm looking like really quite long time frames. Certainly not. This isn't day trades. This isn't like 3 to 6 month stuff. This is stuff, try and buy things cheap and then like buy and hold. That works for me. Maybe you like a little bit more action, but action is generally dangerous unless you're really good at trading. My opinion. I think stay away from financial banks, especially European banks, British banks, US banks. I think we're going into like a financial crisis. But you know, long-term, good quality stocks, especially dividend-paying stocks, if you can pick those up now cheaply. I think we're in a bit of a bear market rally at the moment, but if we see a sell-off, you could potentially buy up stocks cheap. Ultimately, I think the best gains will be from outside of developed Western nations, but then you have other risks, like as we go into a full-scale meltdown, some countries that don't really have property rights that much, you may see assets seized in those countries. It's definitely difficult times, but I think it's really important that everybody at the moment at least has some methods of protecting themselves. I think the stocks and shares ISAs really is a good way of doing that. You know, it's capital gains tax free, which you might think at the moment, well, I'm not really going to make enough in a year to pay capital gains tax. But also, as inflation picks up, it may be easier in the future to trigger that capital gains tax threshold, because as inflation picks up, inflation could be going up at a quicker rate than they're actually raising capital gains tax. So it makes sense. Everything under an ISA is, you know, tax free. It's under a tax free umbrella, no capital gains tax, etc., to pay on money you earn. I mean, I don't want to give people like advice like you should buy this, because I'm certainly no expert myself, but it's a wise move at the moment that everybody at least considers. If you have money, and you know, if you don't care, or if you're heavily in debt, then pay off your debts first before looking to invest money, you know, through various means. But I think if you are someone that 100% of your assets are tied up in UK banks or UK property, maybe just consider if you should diversify where you have money invested, because if there's if the pound collapsed, that means 100% of your assets are denominated in pounds, and you can lose out quite a big scale. So it's definitely an interesting one to think about. I'd love to know what you guys are doing to protect yourselves. I mean, obviously in gold, silver, long-term wealth preservers, you know, there's the theory that back in Rome, a nice toga would be about 1 ounce of gold. At the turn of the 20th century, a nice suit in London would cost you about 1 ounce of gold. And even today, 2020, a nice suit would be worth approximately 1 ounce of gold, right? So gold has a very long track record. Maybe you want to put some of your wealth in there. Obviously, it doesn't return any yield. It doesn't pay a dividend. It doesn't pay interest, anything like that. But it's quite a safe long-term asset. Besides that, I'd much rather own the FTSE than have my money parked in a bank that's paying 0% interest and potentially a collapse of the pound. But you also want to stay liquid as well. So think about this, if we start seeing deflation, if we start seeing asset prices drop, there could potentially be fire sale bargains in the future. You want to keep some liquidity on the side, because who knows, there could be, the car you've always wanted in a financial crash situation. These things might be trading cheap, because as people sell assets just to, pay their mortgage, pay their rent, pay their staff if they're in a business, bear that in mind. So basically, I know this isn't like you personally should do X, Y, Z. All I'm saying is people probably should look into various different means. I think we have ISAs in the UK. It's a sensible investment vehicle. Even if you set one up now and you don't start using it straight away, but if inflation does start picking up, then you think, well, I'll move my money from my bank into my ISA and I'll invest it in something that's a better hedge against inflation. Because investing is not for everybody. I kind of enjoy saving money, and I kind of enjoy putting that money into an ISA and invest it in things. If you're buying a whole long term, generally over long periods of time, that tends to work better than keeping money in banks. But otherwise, just an interesting one, because people have asked me in various videos, how to protect against inflation and stuff like that. And the wealthy people do it because they have, over long periods of time, wealthy people, wealthy individuals have tried and tested measures, or at least people that manage their money for them tend to have tried and tested measures to protect against inflation. Unfortunately, it is the middle class and it is the working class that tend to lose out the most when there is high inflation, or even indeed hyperinflation, which is pretty much no good for anybody unless you can protect your wealth from being destroyed in that scenario. So thanks for watching this video, guys. If you like it, give it a thumbs up. As always, gold is money. Everything else is credit. Jason from Liberty Bunkers sign off, and I'll see you in the next video.